Hello everybody. As we have studied in other video lesson that forward contract is one of the very popular and standard method of hedging. Yeah. So let us understand more little bit in detail what is forward contract. So this is the simplest form of derivatives, this forward contract. It obliges one party to buy and the other to sell a specified quantity of a nominated underlying financial instrument at a specified price on a specified date in the future. So time, price, underlying assets, quantity, all are defined in this contract. Yeah. So the change in the value in a forward contract is broadly equal to the change in the value of the underlying. Yeah. And this forward contract normally unique to every trade. Here we are discussing about the currency trade. And these are customized to meet the specific requirement of each end users. Yeah, so forwards are not standardized. The terms in relation to contract size, delivery, date, location, quality, a credit period are always negotiated. So in a forward contract, the buyer of the contract draws its value at maturity from its delivery terms or a cash settlement. So on maturity, if the price of the underlying is higher than the contract price, then the buyer makes a profit. And if the price of the underlying is lower, then the buyer suffers a loss. The gain to the buyer is a loss to the seller. It's a zero-sum game, right? So, in summary, we can say forward contract is an agreement to buy and sell a foreign currency. Here, because we are discussing about the forward contract in currency market, so I am writing like that: buy and sell a foreign currency at a future point of time for a certain price. It is a sale agreement where settlement and delivery takes place at a later point of time. One of the parties to a forward contract assumes a long position, that is called buy position, and agrees to buy the underlying assets. Here the underlying asset is any one currency on a certain specified future date for a certain specified price. And the other party to the contract would be the seller, assumes a short position, meaning sell position, and agrees to sell the assets on the same date for the same price. Features of a forward contracts are: quantity of the currency to be delivered is fixed or specified or agreed upon. Period after which delivery should be made, that is also agreed upon. Price at which the buyer would pay, that is also defined in the contract. For example, say on 11th of March 2017, Bhushan Steel Limited sells 500,000 US dollar at rupees 62.5 would be deliverable on 31st May 2017. So date here is specified, price at which price that is specified, the quantity and the currency US dollar is specified. Yeah. So purpose of forward contracts are entered to eliminate the uncertainties with reference to future price from both the buyer's perspective and as well as the seller's perspective. So entering into forward contracts does not necessarily mean gain to the party. Gain or loss can be measured only on the expiry date or the contract enforcing date. So that's all about the forward contract, which is a very standard and popular tool for currency hedging. Later in my other video lessons, we will solve practical illustrations. Thank you.